If you work everywhere, where do you actually pay taxes? It's kind of the million-dollar question of the remote work era, right? We've all seen the social media influencers selling that dream of working from a laptop on a beautiful beach somewhere. But what they conveniently gloss over is a pretty jarring legal reality. Holding a digital nomad visa is an immigration permit. It gives you the right to physically be in a country, but it is absolutely not an automatic tax pass. In fact, simply opening your laptop in the wrong jurisdiction can create a cascading financial nightmare for both you and the company you work for. That financial nightmare actually has a name. It's called permanent establishment. Think of it like this. Let's say you're employed by a US or UK company, but you decide to work remotely from a cafe in Germany for 6 months. If you are negotiating contracts, or if your work is a core business function, that host country might just decide that your presence means your employer now has a fixed place of business right there. Suddenly, your overseas boss is legally on the hook for local corporate taxes in a country where they literally don't even have an office. This right here is the exact reason HR departments panic and deny remote work requests.
But what if there was a jurisdiction that actually engineered a legal loophole specifically to solve this problem? A place that not only shielded your employer from those corporate tax risks, but also slashed your personal income tax to essentially zero for your first year. Well, that is exactly what the Mediterranean island of Malta has pulled off. Welcome to The Explainer. Today we're cutting through all the travel blog hype to break down the actual legal, financial, and logistical realities of relocating under the Malta Nomad Residence Permit. We're looking exclusively at the hard data, the tax codes, and the practical immigration takeaways. Here's our game plan for today. We'll start with the Nomad tax trap, break down Malta's 10% solution, look at who actually qualifies, map out the 4-year timeline, cover employer protections, and then compare Malta directly to the other European alternatives. Let's kick things off with Section 1, the Nomad tax trap, and why you need to beware the 183-day rule. So, 183 days. That is the magic number. The crucial point here is that most countries worldwide operate on the 183-day rule. Basically, if you physically stay in a country for more than half the year, literally 183 days, you automatically become a tax resident there. At that point, countries with a worldwide taxation system, like Spain or Germany, are legally going to demand a cut of all your global income. They really don't care if your clients are in New York or London. If your laptop is sitting in their country for 183 days, you owe them money at their standard progressive tax rates.
Moving to Section 2, Malta's 10% tax solution. This is a seriously front-loaded incentive. This is where Malta steps in to solve the problem. In late 2023, they introduced the Nomad Residence Permit's income tax rolls. And the absolute biggest initial draw is a massive front-loaded benefit. For your first 12 months holding the permit, your authorized remote work income is entirely exempt from Maltese personal income tax. Yes, you heard that right, 0%. That is a genuine 0% tax liability on your qualifying professional income for an entire year. It's an incredibly aggressive move by Malta to capture highly mobile global talent. But of course, that 0% holiday doesn't last forever, right? After that first year grace period expires, your authorized remote work income is taxed at a flat rate of 10%. And honestly, this is the true magic of the program. It completely bypasses Malta's standard progressive tax rates, which normally scale all the way up to 35% for anyone earning over 60,000 euros. Instead, you are locked in at a predictable, highly competitive 10%. Let's dive into Section 3, who actually qualifies. Because as amazing as a 0 to 10% tax rate sounds, you have to meet some strict eligibility criteria. This program is highly structured. First, it's explicitly for third country nationals. That means you cannot be a citizen of the EU, EEA, or Switzerland. You must prove a gross minimum annual income of 42,000 euros derived entirely from remote work. Whether you're an employee, a freelancer, or a business owner, your clients must be foreign. You also need comprehensive health insurance covering up to 100,000 euros, and you've got to secure local Maltese accommodation, so an actual lease or purchase property. And that brings us to the absolute biggest compliance trap in the entire program. That 10% tax rate applies strictly to authorized work. That means money coming from outside of Malta. If you decide to take on a single local Maltese client, or if you consult for a Maltese subsidiary of your foreign company, that is considered unauthorized work. Doing so immediately voids your special nomad status and subjects that income to standard progressive local taxes. You are there to bring foreign capital in, not to compete in the local labor market. Next up is Section 4, the 4-year tax timeline. This is a temporary tax framework, and it's essential to understand that going in. This is not a permanent immigration solution. Your initial permit is valid for 1 year. You can renew it up to 3 times, bringing your absolute maximum stay to 4 years. So year 1 gives you the 0% tax exemption. Years 2, 3, and 4 give you the flat 10% rate. After year 4, you max out. At that point, you either have to leave the country or transition to a completely different, much more intensive permanent residency program, like the Malta Permanent Residence Program. But to get those renewals, there is a physical trade-off you need to know about. You must physically spend a cumulative 5 months per year in Malta. You can't just be a ghost. If you hold the card but only show up for a few weeks a year, the Residency Malta agency will flat out deny your renewal. You have to actually be part of the local economy for almost half the year to keep those tax perks. Section 5 focuses on protecting your foreign employer, specifically through the FSS exemption. Remember that permanent establishment nightmare we discussed right at the start? Malta actually built a statutory shield specifically to fix it. To prevent exposing your company, Malta built this explicit promise directly into the legislation. They basically guarantee that just because you are sitting in Malta doing your job, they will not use that as an excuse to claim your foreign employer is doing business in Malta. This carve-out significantly mitigates the risk for your overseas boss. Seriously, it's the ultimate secret weapon for getting your HR department to say yes to your move. Furthermore, to make it completely frictionless, foreign employers are exempt from Malta's final settlement system. That means your employer doesn't have to register for Maltese payroll, they don't have to withhold Maltese taxes, and they do not have to deal with local social security headaches. They literally just pay you exactly as they always have, and the burden of paying that 10% tax at the end of the year falls entirely on your shoulders.
Section 6. Malta versus the alternatives. How does it stack up against other European Nomad visas? Let's ground this decision by directly comparing Malta to 2 other heavy hitters, Spain and Cyprus. When we look at the raw numbers side by side, the strategic differences become pretty obvious. Malta demands a slightly higher minimum income than Spain, $42K versus $34K. But look at the taxes. Malta's 0% first-year holiday and ongoing 10% rate absolutely crush Spain's 24% Beckham Law rate. Cyprus, on the other hand, is fascinating because of its 60-day rule and 0% tax on dividends for non-domicile residents, which is amazing for business owners. But for a straight salaried remote employee, Malta's explicit 10% flat rate and those statutory protections for foreign employers offer unparalleled clarity and simplicity. If the math's making sense for your career, you'll be happy to know the actual application is highly efficient. It's a 4-step process managed directly by the Residency Malta agency. Step 1, you gather your contracts, lease, and health insurance. Step 2, you submit it all entirely online and pay a non-refundable €300 fee. Step 3, you wait about 30 to 60 days for approval in principle. And finally, Step 4, you travel to Malta to submit your biometrics and collect your physical e-residence card. It is a deeply streamlined digital-first process. So, we've explored the strict legal realities, the 4-year timeline, the corporate safeguards, and how Malta stacks up against its European rivals. It is an incredibly powerful tool for the right kind of remote professional. But ultimately, you really have to ask yourself, does your lifestyle actually align with spending 5 months a year on a small Mediterranean island? Or is it just the allure of a 10% tax bracket? Only you can decide if this fiscal shield is the right strategic move for the next phase of your remote career. Thanks for joining us for this explainer, and we'll see you next time.